Hello, my name is Maria Besubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is July 14 and this is a weekly markets update. Let's have a look at the news of week 28 and see what are the next trends. But first, I would like to urge you to watch the fresh mini-series of interviews with prominent market analysts that I launched last week about their view upon next quarter, Q3, in different segments of fertilizers market. I have already talked to Chris Lachopoulos about phosphates, with Silvia Traganida about ammonia, and with Manuja Pandey about nitrates. This week, I will talk with Ed Cox from ICIS about natural gas market, and Deepika Thapriyal as usual about urea. The Indian tender will be finalized, and there will be a lot of interesting points to discuss. Don't miss all these super insightful interviews, and please send me your questions and comments what we should discuss during our next quarterly sessions. Urea price went crazy after first results of the Indian tender, and even before that. India prolonged acceptances until July 15, however, first results we can already analyze, and this is a real shock. I personally expected West Coast L1 to be around $460 or maybe a bit more, and I was dramatically wrong, as many other market participants, I believe. Taking into account previous unsuccessful tender and very low Indian stocks just in the middle of season, suppliers decided to play bold. Anyway, Indians need to purchase the product and will purchase it at almost any price, they thought. And they were right. The vast majority of the offers were around $500 CFR, with L1 of $494 to the West Coast and $495 to the East Coast. By the end of the week, RCF acceptances were issued for 1.3 million tons. Let's see the final confirmed volume later this week. Purchase of more than 1 million tons means that market price level will stay elevated for July and August. At the same time, we understand that there are other supporting factors in Q3, like Brazil entering the key purchasing season, Ethiopian demand, and next Indian tender. That will happen most likely beginning August. So my guess is that there will be a lot of volatility during Q3, nervous ups and downs in price dynamics, but in general, we should expect rather elevated price level. This year, there was no and will not be summer reset, as it usually happens. In the course of last week, there was significant trading activity in the Middle East and Northern Africa after several weeks of waiting. Spot prices in the Middle East started the week at around $470 FOB level and peaked at $505. Sales from Egypt marked the same dynamics. Small lots of 5,000 tons were traded at $470 FOB at the beginning of the week, progressing to the level of $507 on Thursday. Peak sale from Algeria was registered at $515 FOB. Ethiopian ABC closed its tender for supply of 212,000 tons of urea for shipment in July and early August. And the lowest offer was from ETG at $446 to $496, depending on the lot, backed by Chinese and Qatari product. Iranian suppliers also moved their price ideas higher last week to $450 FOB, but no interest at this level. Nigerian Dangote closed a tender on Friday for the sales of two 30,000 tons lots. We will know the results soon. The factor that might ease global supply tension is China. Last week, news about additional quota for exports was circulating without official confirmation, though. There will be up to 1 million tons more product available from mid-October, which will bring total exports volume to 3 million tons this year. It will help Brazilian buyers, of course, but still unlikely that price level will drop too much. Last week, export floor prices increased to $440 FOB for prilled and $445 FOB for granular. In Brazil, the demand was minimal, with offers surging as high as $500 CFR. However, buyers are reluctant to purchase at such level and will take wait-and-see strategy, with last-minute buying closer to the season, in attempt to catch lower price level when global situation eases. In the US, prices nominally jumped, but there is no actual demand due to off-season. The market is concerned with the tariffs, as Trump's administration prolonged negotiations until August 1, but at the same time started issuing letters with new tariff level to some countries. This list includes, for example, Algeria, with indicated tariff level of 30% as of August 1. Also, duty exemption for Russian producers is under question now. A long-awaited, at least by us here in Ukraine, Senate bill about sanctions against Russia and countries that purchase Russian oil and gas finally might be voted. This bill will give President Trump authority to imply a number of different penalties, including 500% duties on all Russian goods as a response to Russia's refusal to negotiate peace with Ukraine. This week, Senate might vote for the bill. Let's see how the situation develops and how exactly this authority will be used by Trump. Paper values surged for all key benchmarks as a response to the Indian tender results. Egypt FOB corrected upwards by $30 and $25 respectively for August and September. Arab Gulf prices jumped the most by $45 for August and $37 for September. The average level for August is expected to be $485 FOB. Brazil CFR also surged significantly to the level of $490 CFR for August and $480 for September. US dollar future values for both August and September jumped by $25 per short ton. Ammonium sulfate market price also reacted at the jump in urea price, but rather modestly. In China, a SCC producer closed one of the largest tenders in terms of volume sold for 66,000 tons of copra-grade product at the average price of $184 FOB. Compacted product offers were heard around $200 and higher FOB. The market expects further increase in values due to urea price rally across the global benchmarks. Brazil was the driver of compacted product price increase, of course. CFR price there surged to the level of $215 to $20 by the end of the week. Taking into account rapidly increasing urea price, sulfate will be even more in demand as an alternative source of nitrogen, as affordability bites. In the US, sulfate producers announced summer fill price at the beginning of last week. The level was set at around $300 FOB NOLA, and after initial round of business increased to $310. This level is $40 to $50 higher versus a year ago, which is not a surprise, of course. Nitrate prices are firm on the back of surging urea price, but demand has slowed down even more. European producers are sold out for July and August, so price offers are now for September delivery onwards. And this is for the next season application. European buyers are reluctant to commit at such high price level for the next season, which is long away. And now they are focused on harvesting. So, Yara last week has reduced CAN prices in Germany by 10 to 15 euros to 350 euros CPT. In Romania, Azomureș confirmed partial restart of its nitrates and NPs and PKs lines amid healthy economics. Both natural gas and ammonia price is relatively low, which gives producer opportunity to operate for the seasonal demand at least. In Ukraine, following heavy shelling of port infrastructure in Odessa region, naval forces proposed ban for imports of ammonium nitrate and ammonia to the Ukrainian ports during war. This is not the final regulation yet, and definitely it will meet some resistance from the farmers and importers, so let's see how it will be finalized. I definitely agree that imports to the Black Sea ports is a very dangerous idea. However, leaving Danube ports open for these imports, as it was during first years of the war actually, might be a solution. Yes, Danube ports also experience shelling, but still they are located right at the border with Romania, so at least the risk is much lower there. I will keep you updated about the status of this regulation. Demand in South and Central Americas is robust, and availability from Baltics for August seems to be very tight, so prices jumped there last week to $320 to $30 FOB. In the ammonia market, sentiment west of Suez continued to be firm, also fueled by the accident in the Baltics with Eurochem largest ammonia carrier. The details are not available, so it is unclear if other vessels are able to load ammonia in the port of Kluga. If not, the market might lose about 60,000 tons of product monthly. Supply from Trinidad seems to be steady for now, no signs of gas curtailments. In the US, there are rumors circulating that the second vessel from Gulf Coast ammonia plant might be loaded in August, but it is not confirmed yet. European values increased a bit to the level of $470 to $90 CFR, but it is rather notional. In Turkey, there is interest for spot cargoes, also from Gemlik, which suffered production issues at its own plant. However, higher values meet resistance with the buyers. Iranian volumes for second half July onwards were discussed, but no deals were concluded last week. Supply east of Suez continues to improve as Ma'aden finalizes its maintenance. Producers' targets remain unchanged at the level of $350 FOB. Demand in the Eastern Hemisphere increased last week amid spot interest from India and Far East, but no deals were confirmed yet. Indian buyers, as well as Turkish, are in discussions with Iranian suppliers for second half July-August shipments. Phosphate prices continue climbing, no signs of cooling down. India continues purchasing DAP cargoes ahead of Rabi season. Last week, India has acquired cargoes originating from Egypt and Jordan, with prices reaching more than $830 CFR. This is for Jordanian cargo. There is uncertainty surrounding the implications of these transactions on the DAP tenders for Hurl and NFL. Both are currently engaged in discussions with parties that have made offers for their tenders, but it is challenging to predict where prices might end up in light of the recent transactions. Offers in the tenders vary from $804 CFR to $818, but there were no final deals confirmed last week. The market is eagerly awaiting the private sector tender in Bangladesh, which might seek as much as 500,000 tons of DAP. However, the timing is not known yet. Clearly, it is another factor supporting bullish sentiment. Chinese FOB prices increased amid robust demand in the region and availability that is tightening. The level was assessed between $755 to $70 FOB last week. In Ethiopia, EABC received offers for Chinese product under their latest tender, with the lowest offer at almost $785 FOB. Awards are being expected. Moroccan OCP has reported multiple sales to Europe at more than $800 FOB. Egyptian offer levels also increased to $810 FOB for latest sales. In Brazil, MAP prices were stable at $755 to $65 CFR with no fresh spot sales. Demand for MAP decreased this year, imports down by 5% in favor of TSP and SSP due to affordability issues. However, interest in SSP also declines, driven by high prices. US NOLA prices remained largely unchanged, with market activity muted due to off-season. Moving to the fundamentals. European natural gas futures rose to €35 per megawatt hour, supported by forecasts for warmer than average weather and stable supply. Next week is expected to bring elevated temperatures, following the hottest June on record for Western Europe. Meanwhile, the European Parliament approved relaxed gas storage rules, allowing countries until December to meet the 90% storage target, reducing the risk of inflated prices. On supply, Total Energy CEO said Europe will manage without Russian LNG by 2028 due to new capacity in the US and Qatar. US natural gas futures fluctuated around $3.4 per MMBtu, rebounding from midweek lows, driven by rising LNG export flows and forecasts for hotter than average weather, which is expected to increase demand through late July. Gas flows to the 8 major US LNG export plants averaged 15.6 billion cubic feet per day in July so far, as several facilities resumed operations following maintenance and outages. On Thursday, LNG feed gas was on track to hit 16 billion cubic feet. Also, warmer weather forecasts suggest higher cooling demand will persist. Agricultural commodities future prices all dropped after issuance of the fresh USDA report. Wheat futures dropped to $5.45 per bushel, pressured by stronger than expected yields in Kansas and following release of the USDA report. Farmers in Kansas, the top winter wheat producing state, reported favorable harvest results despite early season challenges, with some test weights and protein levels holding up well. The WSDA report showed a mixed outlook, projecting U.S. wheat production at more than 1.9 billion bushels, up by 8 million from last month, due to higher yields despite reduced harvested acreage. Globally, the wheat outlook reflected reduced supplies and ending stocks, with lower production in Canada, Ukraine, and Iran, outweighing increases in the EU and Russia. World trade was revised lower due to weaker exports from the EU and Ukraine, though Russia and the US are expected to ship more. Corn futures fell below $4 per bushel, driven by strong global supply prospects and signs of weakening demand. In the US, 74% of corn crop was rated in good to excellent condition, well above the 5-year average, while weather models point to continued favorable conditions across key Midwestern states. Similarly, Brazil is harvesting a large second crop, adding exportable supply at a time when the global market is softening. In Ukraine, export activity has slowed sharply, reflecting seasonal, and traders are turning their focus to wheat and barley. Despite the USDA's July trimming global corn stocks and production, its upward revision to US ending stocks confirmed lingering supply overhangs, reinforcing the broader bearish tone. Soybean futures fell toward $10 per bushel, pressured by a mixed outlook for the 25-26 season following the WSD report. US production was trimmed slightly due to reduced harvested acreage, while yields remained unchanged. Domestic crush was revised upward by 50 million bushels, reflecting stronger demand for soybean oil used in biofuel, driven by the EPA's proposed renewable fuel standard revisions and additional policy incentives. In contrast, exports were lowered by 70 million as robust domestic demand and increased global competition, particularly from Argentina, Ukraine, and Brazil, weighed on the outlook. On the global front, both production and crush are expected to rise, but exports are forecast to decline, contributing to higher global ending stocks. Moving to the shipping industry. Containerized freight index hovered on the level same to previous week. Freight rates from China to US dropped slightly by 5 to 8%. Same trend is registered for freight rates from China to Europe. The tariff war continues, and finalization of global tariffs agreement will influence further trends in the global container trade. The Baltic Exchange Dry Index rebounded by almost 200 points last week. The Capesize market reflected a cautiously optimistic tone, with firm activity in the Pacific and a gradually improving Atlantic. The Panamax sector experienced a notable surge, particularly in the Atlantic basin, where momentum picked up midweek as tonnage supply tightened across the continent and West Mediterranean. Conversely, the Asian market presented a more subdued picture. For ultra-supermax sector, it was a strong week as well, as a general tightness of tonnage availability and better amount of cargo saw rates improve in most key areas. Handysize market remained steady and relatively balanced throughout the week. The other sad and worrying news came from the Suez, where 2 vessels were sunk by Houthis during past week. The first vessel was bringing iron and fertilizers from China to Turkey, and luckily all crew members were rescued. However, the second vessel was heavily damaged, and 3 crew members died and 7 more are missing. It happened for the first time a year that Houthis attacked and sunk vessels. Of course, it is extremely worrying for the global trade and shipping, as the most important route continues to be insecure. To sum up, Indian tender result came as a surprise for the market, with lowest offer being almost $500 CFR. Incredible. India was quick in issuing LOIs, and by the end of the week, more than 1.3 million tons was accepted. We will see the finalization of the tender this week, but it is already clear that such significant purchase amount will keep price level elevated for July and August. Other factors of support include demand from Ethiopia as well as from Brazil that will emerge later in Q3. However, Chinese additional supply of 1 million tonnes until mid-October should ease the tension to a certain extent, if really this volume enters the market. Ammonium sulfate price responded to the jump in urea, but quite modestly. Further demand from Brazil should support further upward price correction, as well as nitrates price increase in Baltics that happened last week. Phosphates price continued breaking records. Last sales to India firmly capped above $800 CFR, and price unhesitatingly moved higher last week. Demand from other regions was suffering due to affordability issues. Gas price in Europe climbed amid hot weather across the region. US price hovered at the level of previous week. Agricultural commodities future prices dropped for all key crops after issuance of the fresh USDA report, which showed more ample supply than previously expected. Container shipping activity was largely unchanged, with prices stable. Bulk shipping, on the contrary, showed a positive vibe across all segments and geographies. However, new Houthis attacks make Suez's waterway unsafe again. So let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.